Today, I'm going to talk about three stocks that are trading near their 52-week lows. And so these are big blue chip stocks, and I'm going to take a look at whether they're worth buying. So I'm going to talk about Cisco, Johnson & Johnson, and Nike. So let's start with Cisco. So Cisco is a big name in computing hardware, and right now it's at $46, which is right around its hit a new 52-week low today. So it's been struggling this year to date. As you can see, it's down about 8.5%. And so a big problem with the company is that its results just simply haven't been all that good. So if we look at its most recent third quarter earnings, May 15th, revenue is down 13% year over year. And so demand just hasn't been very strong, even though they've been growing. They've acquired Splunk, which is going to help it in cybersecurity. Revenues aren't doing well, and so at a time when a lot of tech stocks like Nvidia are doubling, tripling revenue, Cisco's not really that exciting to invest in. But the reason I do like it as a potential investment right now is because it's still an important player in hardware solutions. It's got a lot of AI ready infrastructure networks, so all that stuff that could potentially see a surge in demand, especially when companies start upgrading their PCs, buying new computers. They could be, companies could be due to upgrade all their infrastructure along with upgrading their computers. So there could be a lot more spending coming in Cisco's future. So even though demand's not great right now, it's still a fairly good business in the long run, in the sense that it should be able to get a boost in spending, because right now companies are spending less because of inflation. Some are worried about a recession, so spending is not terribly strong right now. And if we look at Cisco's fundamentals, its financials, the business is still doing fairly well. Look at its net income over the trailing 12 months. So 12 billion in profit on 55 billion in revenue. So it's got some pretty good margins there, around 20%. So really, really highly profitable business. What's also appealing about the stock is it pays the dividend about 3.5%. So even if all you do is wait for the company and for the business to bounce back, you're still collecting a pretty good yield. And in terms of valuation, it's trading at almost 16 times earnings, and on a forward basis, 12 to 13 times its future earnings. So it's a reasonably priced stock. I think it could be an underrated one, because once companies get back to upgrading their systems, upgrading their IT, Cisco's revenue should be a whole lot better and get a bit of a boost. So right now, sales have been down, but with the stock at a 52-week low now, it could be a good time to set up to buy the stock in for the long run. Now, another stock near its 52-week low is Johnson & Johnson. So at 144, it's close to its low range of 143. So it's trading at 21 times earnings. It also pays a dividend of 3.4%. So one thing that Johnson & Johnson is working on is re-energizing its growth prospects. So it's investing in what it says next wave of healthcare innovation. So it's spending money. It expects its business to grow operationally between 5 and 7% between 2025 and 2030. So one of its top drugs, Stelara, is losing patent protection. So there's going to be more competition. That's going to chip away at its growth. So that's a struggle for the company, but it is planning to invest in its business. So it spun off its consumer health business to focus more on growth. So 5 to 7% compounded annual growth over the next up until the end of the decade. So it's growing at a potentially decent pace. Now, the one thing I don't like about Johnson & Johnson, though, is this is a company that always has a lot of legal bills and legal troubles to worry about. Its talc lawsuits still haven't been resolved. And if you look at its financials, you may be surprised to learn that, litigation, they spent 6.9 billion on 2023, and that involves a talc charge. So it was setting aside money for those talc lawsuits. In 2022, it spent 0.9 billion on litigation. And then if we go back to 2021, again, another 2.3 billion, 5 billion in 2020. So again, talc, opioid litigation, the company's always seemingly involved in lawsuits. And so that's something that seems to always continue to weigh on the business. So that's the big risk involving Johnson and Johnson. What I don't like about the company is that, between the dividend, it's paying a lot on the dividend. It's paying to grow its business because, again, it's facing those biosimilar competition in the future. And at the same time, it also has those legal bills to worry about. So I see this as a potential stock that could be another 3M, which, although it's been growing its dividend for decades, it could be due to cut it in the future just because it's got all those cash needs coming out of the business to grow its business, to pay its legal bills and its dividend. And whether it can keep all that stuff going, is a big question mark. And that's why I think that even though the stock may look a bit cheap, it comes with a bit of risk right now, especially as it's still trying to balance all those different initiatives and focus on growth. So I'm not crazy about a Johnson & Johnson stock. So even though the dividend may look attractive, this is a stock I think is worth staying away from, just because until it sorts out those talc issues, especially, it's going to be a risky buy for the foreseeable future. Next up is Nike. So at $91, $92, it's a few dollars away from its 52-week low of 88.66. It's trading 27 times earnings, so it's not terribly cheap. It also offers a dividend of 1.6%. If you look at its most recent numbers, period ending February 29th, revenue was basically flat, 1%, so 12.4 billion, again, compared to 12.4 billion. So no real change on a quarter-over-quarter basis. Net income, though, still was profitable. Net income only declined by 5%, so still fairly resilient at a time when inflation's still high and people are cutting back on spending. One really encouraging report is every year Piper Sandler has a teen survey done, and one thing that stands out to me is that Nike is still the top brand for teens in both apparel and footwear. So that speaks to the strength of its brand, that even right now, even when people are feeling the pressure of rising costs, that teens still rank that brand really high. So you can see that even among other brands, American Eagle, even Shein, Nike's still top with young people. So that's definitely an encouraging sign and a reason why this might be an underrated stock to buy, even though it's a bit pricey at 27 times earnings. I think the strength of Nike's brand is a good reason why this could be a good stock to buy. Sales were flat last quarter, but at the same time, there's a lot of challenging economic conditions right now facing not just Nike, but other retailers and clothing brands. So I think if Nike's still able to generate any kind of growth, that's still impressive, and the brand's still obviously popular with young people, I think this could be a good stock to buy right now at close to its 52-week low. So I think Nike's a good buy. I think Cisco's a good buy. I think Johnson & Johnson, even though it's cheap, I think that one is a bit of a risky play, but I think Nike and Cisco are good buys right now and potentially underrated, especially at a time when even though the markets are really hot, those stocks could provide a lot of value in the long term.